Welcome to Yahoo Finance's special coverage of the December jobs report. I'm Julie Hyman, and we are just moments away from the payroll sprint. Joining me to preview the results, Joe Brusuelos, RSM chief economist, and Steve Sosnick, Interactive Brokers chief strategist. Joe, I want to start with you because we've talked with you about the sort of aftermath of the government shutdown and when we would start to get quality numbers. How seriously do we take the numbers that we're getting today?
Well, we want to take these numbers very seriously. It's the first clean report, but I want to point forward. We're going to get a benchmark revision next month.
Oh, gosh.
So we should temper our enthusiasm about whatever the top line is.
Okay, good to know. Steve, what about the effect on the markets? Are we still in this sort of like good news is bad news situation?
I think we're sort of in this all news is okay news situation, you know, kind of. I mean, we came in with options pricing at about a 0.9% move today, which, considering the fact that there's the potential for a Supreme Court decision on tariffs, is actually pretty light implied volatility. I think they just figured there's nothing's really going to move the needle too much on the jobs front, but obviously we have to watch and wait.
Yeah, and just for viewers who are watching, of course, the jobs report is important. Starting at 10 a.m. today, as of 10 a.m., that is the earliest we could potentially get a decision from the Supreme Court on President Trump's tariffs. It seems like he has a lot of backup plans to put tariffs in place, even if it gets struck down, but it's something to watch. As we are getting ready for the jobs report, just wanted to bring you the last moment estimates that we got from Bloomberg, who surveyed economists. 70,000 is the overall change in non-farm payrolls. That is the consensus that we're looking for. The unemployment rate expected to tick down to 4.5% from 4.6%. Again, the last report was not a quote-unquote clean report because of the government shutdown. So those are the two big numbers we're going to be watching. Average hourly earnings, 0.3% is the estimate, up from 0.1% the prior month. So looking for these December numbers, 50,000 is the headline number, 50,000 versus the 70,000 that had been estimated. The unemployment rate, however, coming down more than anticipated to 4.4%. So those are the two headline numbers, 50,000 jobs added to the U.S. economy in December versus the 70,000 estimated, and the unemployment rate ticking down to 4.4% from 4.6% in November. Average hourly earnings in line with estimates, rising 0.3%. Average weekly hours at 34.2, and the labor force participation rate in line with what economists have been looking for at 62.4% versus 62.5%. So those are the overall numbers. I'm going to start digging in here under the hood to see what kind of revisions we're getting. It looks like at least for the prior month, for the month of October, we had some, or the month of November, I should say, we had some downward revisions. We'll see how far back that goes. But I'll dig in as well to see where we saw additions and subtractions. Joe, your sort of first blush reaction here.
We only need 50,000 jobs a month to keep labor conditions stable. That's what we got, almost spot on with the 51,000 three-month moving average moving into this. So we'll want to open this up and decompose it a little bit, look at the internals. I did notice there was an 8,000 decline in manufacturing. The manufacturing sector, for all intents and purposes, is just stagnant right now. That has a lot to do with tariff policy. So we'll open this up and take a look at it. The unemployment rate did decline to 4.4%. Now, I had it going down to 4.5, so we got a little bit of an overshoot. I want to see what the deal is, if that's because a lot of people left the labor force. And look, everybody, we're going to get a big benchmark revision next month. We expect, on average, 60 to 80,000 decline per month in total job creation. So these numbers are all going to look very different 30 days from now.
Okay, I'm going to come back to the benchmark revisions a little bit later, but just to talk more about what we're seeing in reaction to these numbers, good enough for the market, Steve? Like, how should we be viewing it from that perspective? It looks like futures are ticking up a little bit on these numbers.
Again, there's not enough here to upset the stock index futures. I'm looking at bond yields up a couple of basis points. The curve really hasn't changed very much. It's sort of in the same place we were. Call it about 68 basis points between 2s, 10s, which I am trying to. One of my fears is that we get a bit beyond 70, 75 on that one, and that I think and I see, Joe, you're agreeing with me.
Yes.
That one I think would be problematic. We're still in that watch and wait range there. I think, as Joe said, think about it this way. 20,000 jobs in an economy that has how many 170 million workers, give or take. Talk about an eyelash difference. I think these are okay. There's nothing in here to change perceptions too dramatically one way or the other.
And just to give it a little bit of what I mentioned under the hood in terms of the details of this report, healthcare continues to be an area of strength in the job market. It saw a gain of 21,000 overall. Food services and drinking places, restaurants and bars, in other words, also saw pretty strong gains of 27,000. And social assistance continued to see increases. In terms of where there were declines, retail jobs down by 25,000. So that is quite interesting, especially at a time when it was the holiday shopping season. And remember, these are seasonally adjusted numbers, so it's, they account for some of those changes. So interesting here. Federal government employment, little changed in December, up 2,000. That's something to continue to watch too. Again, because of the sort of shakeout from the government shutdown. So those are just a few of the numbers that caught my eye. In addition to having Steve and Joe here with me on set, we're also joined by Leslie Falconio, UBS Global Wealth Management, Head of Taxable Fixed Income Strategy. Leslie, it's always good to get your perspective on these days as well. What is your take on this report?
Listen, I think the commentary that you've had is spot on. We have these seasonal adjustments coming up. This really hasn't been a big mover to the marketplace. On a bright side, we've had the unemployment rate tick down. It actually was revised down as well. But this, in our opinion, is pretty much as expected. You're not seeing big market move. And more importantly, if you look at the probability of a January cut, it's only 11%. So it's not as though people were looking at this number as some sort of swing as to whether or not it would increase the probability of a cut in January. This isn't it, so we don't think they are going to. So we look for one cut in the first quarter, but this, in our opinion, is really sort of a spot-on kind of report, not really big in terms of a market mover, in terms of Fed policy. But we also know this data is still a little clouded. We're going to have some revisions coming up, and obviously we have things like the CPI data that we need to watch out for.
I mentioned earlier the revisions. It looks like October was revised down by 68,000. November was revised down by 8,000. And so that's something to consider as well, everybody, when we look at the numbers that we're watching here, that the 3-month average is now actually showing a bit of a contraction. Joe, so when you look at these numbers, also, by the way, considering that we still did see an uptick in wages of 0.3%, how would you characterize the job market based on this and the numbers we've gotten thus far?
Well, it's the no fire, low hire is intact. When I looked at the numbers here really quick as we got to see them, there were only 9,000 jobs added outside of healthcare and private education. So the private sector is really engaged in an extended pause with respect to hiring. Now remember, we've got two-sided risk around the labor market. We've got a supply and a demand issue, right? We've got demographic issues because of the retirement of the boomers. We've got a real constraint because we're no longer importing external labor, or labor from the external sector. And then every time I talk to a CEO, they're not hiring because they're taking some time to assess the impact of all that technology that they've invested in over the past number of years to see, do I really need this many people to meet my demand? And what I'm seeing here, because we saw that big increase in productivity right now, and this is not even AI, everybody. AI has nothing to do with the productivity numbers that are out there. We're able to produce a lot more with not as many people. So we're moving into a different spot. And I think the big takeaway, though, is that it looks to me as if growth is decoupling from hiring. We're going to have a much more interesting discussion around that this year.
What does that imply for earnings, Steve?
Well, if productivity is improving, that's good for earnings because you're getting literally more production out of the same unit of labor.
But if fewer people have jobs, what does that mean for spending?
Well, right now we're in an okay situation. I would love to get Joe's opinion. How much of the productivity improvement was a result of sort of the end of the COVID era labor hoarding? Because I think we did see a lot of hoarding of people. We're afraid, it's hard to hire, we're hard to, we can't afford to lose them. Now we're okay sort of letting them slip away because, maybe this AI will work, but just more in general, we've had a lot of people on board and we really can get the same amount of productivity out of fewer workers. that would be good for earnings. If it extends way beyond, the micro level and becomes a macro issue, yeah, that becomes a problem for the economy as a whole. We're not seeing that in the numbers today. I think we're in an okay situation from that point of view of productivity that should make it to the bottom line without yet really affecting the economy in a terribly negative way.
I'm going to ask Joe to respond to that, but not yet. We're going to put a pin in that one and come back to it in a minute because I want to bring Leslie back into the discussion as well. And Leslie, what does all of this imply for where yields are going to be this year? If you're looking at this sort of low hire, low fire, if you're looking at a job market that is okay, and the interest rate outlook that you talked about, what does that then imply for fixed income?
It's amazing. Since the end of August, the 10-year Treasury yield has been between a 4 and about a 4.2%. I mean, the lack of volatility within the interest rate market is really quite incredible, and it's almost concerning because when you start to coil like this, there's a breakout coming, and what causes that breakout is yet to be seen. I mean, we happen to believe that over the course of the year, the 10-year Treasury is just going to stay between 4 and 4.5%. Not that dissimilar to what we saw in 2025. But with that said, you're going to have these outliers sort of pocket moves simply because there's so much going on. The Supreme Court could make a decision late this afternoon. We have midterm elections. We have so much going on in terms of, besides, Fed policy that is going to influence this marketplace. So while we think 4.5 the majority of the year, that doesn't mean you can't see a 3.75 at some point. But this will be a year where you have the ability to be tactical, but we don't expect these really large ranges within the 10-year Treasury yield because we were more of the ilk that the Fed cuts, they do non-recessionary cuts, but we aren't one that believe that they're going to cut 100 basis points.
I have a little bit of a left turn question for you, Leslie, because it's on my mind, and that's what the president said yesterday about wanting Fannie and Freddie to come back into the market and buy $200 billion worth of mortgage-backed bonds. They do this already. This is part of what Fannie and Freddie do. And I don't know how quickly what he says will happen, if it will happen, all of that. But how are you thinking about that making its way through the market?
Well, so we've been wrong, and I've spoken to you about this before. We've loved agency MBS as a sector to invest in. They're definitely cheap. They've been cheap to corporates. I think this is a great move by the administration to get GSEs to buy. But there's one thing you have to remember is that unlike the Fed, who doesn't hedge, when they did QE, they just took mortgages out of the marketplace. The GSEs, they hedge. So you're not really taking, I would call, duration of the market. Interest rates lower, but what you're doing is you're compressing that spread, that MBS spread, which is one of the inputs to the mortgage rate. So while this will, bring that mortgage rate down a bit, it's definitely not a cure-all. I look at this as sort of maybe an appetizer of what's to come. It'll help bring the mortgage rate down, but then again, if you have something like this afternoon where the Supreme Court, rules against some of these, you have the 10-year Treasury moving up 30 basis points, you can worry about that benefit. So it's a great first step. I think it's an important first step, but it's not going to be a cure-all. And more importantly, it's really, in our opinion, focusing on the demand side of the housing market is great, but you really need to focus on that supply side to lift the affordability issue.
And I imagine we're going to get some news on that front throughout the year as well. Everybody, stick around with me. We're going to be right back and talk more about this. But in the meantime, I do want to send it over to Jared Blickry for a look at the movers on the back of this payrolls report. Jared?
Thank you, Julie. We are looking at some green in the major indexes, at least their futures. And let's dial up the Wi-Fi Interactive. We can see the Dow lagging the group, and we'll start there. It is up about 146 points overnight, 1/3 of 1%. We got a little bit of lift off on that report. Not good enough for a record high on the open, most likely, but still pretty close to that mile marker. Here's the E-mini S&P 500. That's up 1/3 of 1%, a little bit more than the Dow. And here's the NASDAQ, a little bit more than the E-mini S&P 500. That's up 0.4 of 1%. But really stealing the show here, by just a little margin, is the Russell 2000 futures. And those are up almost 0.5%. And it looks like on the open, we will probably be printing a record high for the small caps. That is a continuation of their breakout story, which the previous breakout stories in the small caps has been short-lived. So we'll have to see if this one has any legs. But let's shift over to the bond market real quickly. These These are 2-year U.S. Treasury note futures. These move opposite yields. And so we saw a little bit, we started out in the red, meaning yields were up, and then we took a little bit of a dive on the report, but we're coming up right now. These are pretty small moves. And I'm going to show you the 10-year tenor next. And you can see still in red territory, which means yields are up right now, but kind of moving towards that unchanged line from 3 p.m. yesterday when the bond market closed. And let's take a look at gold as well, because that was up on the announcement. It's up 0.8%. We know gold has been really a story of 2025. Investors wondering if that narrative is going to continue into the future. I was also checking out Fed fund futures, and there was not a big likelihood of a January rate cut coming into today, but now there is less of one, and probably on the back of that strong unemployment number that we got. And let's check out the sector action as well. This is what happened yesterday. Energy was leading, tech was lagging, but I'm going to throw on the overnight quotes, and those appear in little rectangles here. You can see utilities up 1.6%. That's off of the Meta news that they are just hungry for power. And Julie, you and I are going to be talking about that in about 30 minutes or so. Second place is tech. Yesterday's laggard is one of the leaders today. It's up 0.5%. And then industrials, financials, staples, and healthcare round out that top row. Nothing in the red looking at the early quotes just yet. Here's a NASDAQ 100. I know there's a lot of numbers here, but just real quickly, some of the bigger movers. We got Alphabet almost up 1%. Meta, I was just mentioning that. They're only up about 0.2%. But Nvidia, Apple in the green, so is Broadcom after a big loss yesterday, and Tesla as well. And I'll send it back to you on that, Julie.
Looking forward to our energy discussion later, Jared. Thank you. Coming up, more on the December jobs report, and we'll broaden it out, look at some of the other recent economic data as well. A little bit more of that productivity discussion. The December jobs report showed 50,000 jobs were added last month. But let's talk about now what industries saw the biggest gains and losses. For that, we go to Yahoo Finance's Brooke DePalma for the details. Hey, Brooke.
Julie, good morning. Once again, healthcare, leisure and hospitality, food and drinking places were some of the biggest gainers. And if we break it down, let's take a closer look at what exact sectors saw the most jobs gained in the month of December. Taking a first look, food, services and bars gained about 27,000 jobs, largely led by those higher income consumers continuing to go out. Likely healthcare, an ongoing gainer within this job market. That sector added about 21,000 jobs. Worth noting that food services and bars, this was the largest monthly gain for the sector as well. And social assistance, that was mostly jobs added about individual and family services. In total, that sector added about 17,000 jobs. And one sector that we just cannot stop talking about is the federal government. I know you already noted that, but within that sector, federal government added about 2,000 jobs. Now, it's worth noting that we are down about 277,000 jobs, or about 9.2%, since the federal government job sector reached a high back in January. So that's a pretty significant amount of jobs lost within the federal government, largely because of that the DOGE layoffs that really hit a peak, losing about 174,000 jobs based upon the revisions in the month of October. But there were other losers within this sector, or rather there were losers within the jobs market as well during the month of December that saw jobs lost. And that does include retail trade, down about 25,000 jobs. Other sectors that lost jobs as well include warehouse clubs and general merchandise stores. That was down about 19,000. Other that also saw job losses were the food and beverage retailers. Within that sector, we lost about 9,000 jobs. And so certainly healthcare, leisure, and hospitality continue to see momentum. But on the flip side, we are seeing losers within retail trade, warehouse clubs, among others.
Brooke, thanks very much. Appreciate it. Well, let's get back to the productivity discussion, because we saw U.S. labor productivity accelerating in the third quarter. This was numbers that we got yesterday to the strongest pace in 2 years. 4.9% on an annualized basis. That was according to data from the Bureau of Labor Statistics. Still with me, Joe Brusuelas, RSM Chief Economist, Steve Sosnick, Interactive Brokers Chief Strategist, and Leslie Falconio, UBS Global Wealth Management Head of Taxable Fixed Income Strategy. So that number on productivity, we were just sort of talking about productivity a little bit and why we saw that big increase in productivity. Joe, what happened there?
Well, we're producing a lot more with a lot less people. This is at the end of the day. Look, the productivity boom started in 2023. By the way, great data viz, everybody back there in the production room as we went to break. I really loved that. It looked great. And, you know, what's happening is a couple of things. Total factor of productivity, which the economist, they will go right to that to say, hey, if that's increasing, I think it was up 12 of the 21 major industries saw an increase in TFP through middle of the year last year. So there's a good thing happening here, right? And we don't want to lose that amongst all that other noise in the news right now. However, some of this undoubtedly has to do with the fact that labor hoarding, which had been with us since the pandemic, has come to an end, and big corporations are right-sizing. That's one of the reasons why we're seeing these very, very modest increases on a monthly basis, because they've integrated some very sophisticated technology into the production of goods and the provision of services. Don't think of it as AI, think of it more as machine learning. Now, the AI boom, the productivity boom that we all talk about here on Wall Street, that's still a couple years away, right? It's going to happen. But we're beginning to say, look, we put so much money on the table. What are we getting on our return for investment? Where do we need to deploy the newer technology, right? How can it help me make my firm more efficient and more productive? And this is going to be one of the big issues, because we're going to grow pretty strong this first half of the year. I'm thinking about 3%, but our forecast was 50,000 a month for the entire year. Well, Steve and I aren't going to have any problem with that, because earnings are going to be good, profits are going to be better, the economy is going to grow. It's a bit difficult to explain to the public. Once I get outside New York, I go west of the Hudson, people get a bit pissy when I talk about 50,000. Well, what do you mean? Well, what it means is this is all we're going to grow. You're all employed. Your wages are going to improve, but it's going to be more difficult finding a job. Inside that data this morning, the median duration of unemployment went straight up. And compared to where we were last year, people working part-time for economic reasons has increased by 980,000. So we're more productive, but if you want a new job, it's going to be a bit challenging.
Well, and Leslie, to come back to you on this, we were just talking about some of the measures, the early measures that we're seeing this administration try to put in place on the affordability front. I mean, as an investor at this point, do you have to try to then maybe theorize to some extent about what may be coming down the pike on that front and get ahead of it?
No, I think so. I mean, I do agree, or I do believe that, as we just talked about earlier, this is more of the appetizer when it comes to GSEs buying, because again, you'll have the mortgage rate might decline on that somewhat, but depending on what the 10-year Treasury yield does, but it's not going to get to the level where it's going to, influence affordability materially. I mean, in order to really do that, unfortunately, you have to be more on the supply side, in my opinion. There's demand side things that can be done, maybe in Davos they announced some sort of, reignite of the Operation Twist or something that bring down that 10-year Treasury yield. But otherwise, a Fed cutting once or twice is just simply not going to do it. And, I do agree, when we talk about this productivity, the number of 4.9%, obviously it can be very volatile. But even when you look at the, 10-year average, it's running about 2%. But this sort of no higher kind of environment, I do think is going to be an issue down the road. And when the Fed cuts once or twice, you're not really doing anything to help that part of the equation. It might be great for small businesses, might help a little bit in terms of someone's car loan, but it's not going to be enough of a push where you really influence the K-shaped economy. Or do we think it's going to really, this recent measure, going to heavily influence the affordability issue? So I do believe there's going to be much more down the line. But again, there's things that they have to be considered. Like if you give tax incentives, you got to go through Congress. You have to look at the deficit. I mean, there's a lot of obstacles to go through before we can really address this issue.
Yeah. I don't know. I want to glibly say deficit, schmeficit. Nobody seems to care about that in DC anymore, but that's a discussion for another day. Steve, but this does bring me to the idea that we continue to have this strange disconnect, right? Where the vibes are bad, as we know, on Main Street. Markets continue to go up. Companies continue to mint more profits. From an investment standpoint, are there implications of this, or can this kind of continue indefinitely?
It can continue for quite a while as long as the vibes remain okay. Part of it is, both Joe and Leslie referred to the K-shaped economy. I'm going to assert, I think we've gone from a small K to a capital K, and we may have actually an inverse small K, but the thing here is investors live at the top half of the K, and we can debate the social aspects of that, but bottom line is that's what it is. So as long as investors feel okay with all this, this is going to continue. Individual investors also feel even more more emboldened by the stock market, and also more tied to it. I think among younger investors, a lot of them are sort of, I've seen the term financial nihilism. I've used the term nihilist market before, but I've never used it, but someone else came up with the other term. And I like this idea because they sort of figure, it's how am I going to afford a house? How am I going to afford the lifestyle that I grew up with? And maybe the stock market, maybe crypto, maybe prediction markets is the way out.
Well, on that housing affordability issue, right, and the proposal of $200 billion in mortgage-backed security purchases, between 2020 and 2022, the Fed purchased $1.3 trillion out of the $1.5 trillion, and 90%. $200 billion is not really going to move the needle much. It's going to account for basically a 25 bips rate cut. That's it. When it comes to housing affordability, we don't have a financing problem in this country. We have a supply issue.
Right. Leslie was talking
and
about
this. And this is really critical, because if you alter the mechanisms of finance to force rates down, what happens is people come back in the market and they bid the prices up because we got insufficient supply. What got buried here today is that housing starts number, 1.246 million at an annualized pace. I'm sorry, that's a big deficit. We need to be doing 2 million at an annualized pace, and we're really short housing here. So those proposals actually may be counterproductive.
Okay, we got to leave it there, unfortunately. Joe, Steve, Leslie, thanks so much. We'll be back with much more analysis on the jobs story. Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the December jobs report. The U.S. economy added 50,000 jobs last month, below Wall Street estimates, as the unemployment rate ticked lower to 4.4%. The data, though, did little to move the needle on Fed rate bets, and we're not seeing much of a reaction to the report in the market. That's in part likely because investors are bracing for a Supreme Court ruling on tariffs that could have implications for the markets. The court has scheduled today as an opinion day. What does that mean? Well, it'll be the first chance for a ruling on those tariffs. The court's considering whether Trump can use an emergency law that had previously never been used to implement sweeping reciprocal tariffs. And a ruling striking down the tariffs could give a boost to stocks by promising to improve profit margins and remove a burden on consumers. But the White House could seek to reimpose similar levies by invoking different legal authorities. Meanwhile, bonds could come under pressure as the potential stimulus to the economy complicates the Fed's outlook and could worsen the government's budget deficit. Let's get a check on stock futures in the wake of the jobs report. We do have a small push higher for all three major averages here, as these numbers show that we're perhaps continuing to be in this no higher, no fire, or low higher, no fire environment that still could be promote growth overall in corporate profits. The Dow right now up 142 points, or at least futures are pointing in that direction. The S&P futures pointing to a gain of about 1/3%. NASDAQ futures pointing to a gain of about 0.5%. And as stocks rise following that sort of mixed December jobs report, it maybe does boost hopes for future rate cuts down the line. Joining me now, Brian Jacobson, Annex Wealth Management Chief Economist and Strategist, and our Federal Reserve Correspondent, Jennifer Schonberger. Jen, I want to go to you first, because we got these numbers. I was just talking to a panel and they said, okay, this doesn't really change things in terms of January and getting a rate cut. That's probably still not going to happen.
Yeah, I would agree with that. You know, we were a little light on the payroll number, but the fact that the unemployment rate dropped to 4.4% as a labor force participation rate held steady shows that while the labor market is cooling, it's still very much healthy. It does not signal recession at this point. And remember, the number one indicator that Fed officials look at for the health of the labor market is the unemployment rate. So the fact that it fell to 4.4% as people continue to look for jobs is a healthy sign and does keep the Fed on course to take a breather later this month. However, it does not preclude them from potentially doing one or two more rate cuts sometime this year, because as you mentioned, it seems that we continue to be in this low hiring environment. The labor market is gently cooling, and we do expect to get benchmark revisions for the past year next month. For the January jobs report. And the Census Bureau previewed some of that, where we saw that job growth was close to 1 million fewer jobs created. So we'll be looking for more clarity on that and how that sort of informs the Fed's path going forward. So while maybe we're not seeing a lot of layoffs, we also aren't seeing a lot of hiring. And so perhaps the Fed will still need to do some tweaking later this year.
Brian, one of the phrases you used in your notes that you sent to us stood out to me, that there's no labor market churn. It's like, you can say no hire, no fire, or you can say it's like moss growing on a stagnant pond, which is what you said in your notes to us. Describe to us what you mean there.
Yeah, I don't mind the characterization that it's this no hire, no fire, but it does seem like it's almost kind of like it's just sitting there, stagnant, and we're not seeing the growth. A lot of it, immigration reform, we know that's one of the driving things that's affecting the supply side. But on the demand side, as far as employers, are they demanding workers? That's not growing a lot. Let's take a look at 2024. There were more than 2 million jobs created. 2025, it was closer to like maybe 500,000, right? So that is a material move lower. And when we don't see the labor market churn, that's not really a healthy sign. With today's report, one of the things that stood out to me was a slight decline in the average work week, and especially the manufacturing work week, because most of the labor market data that we get is backwards looking. It's oftentimes either coincident or lagging economic indicator. But the one part that tends to be a leading economic indicator is that average work week. And that one actually took a step backwards. So it's, I think, not necessarily the greatest thing that we're seeing.
Brian, it's interesting that you point all this out, because most of the forecasts I have seen for this year are for GDP growth to, maybe slightly accelerate compared with last year. But how do you sort of square that with this tepid hiring environment? Or does hiring have to pick up in order to meet some of those GDP expectations?
One of the ways in which we could square this circle is through productivity growth. And we've already seen an increase in productivity growth, and that kind of creates a sweet spot for the Fed in terms of lower inflationary pressures, faster growth, but it doesn't guarantee at least short-term rapid hiring. It does over the long term, but oftentimes when you get these sudden upticks in productivity growth, it doesn't require more workers. Maybe it just requires working your existing workforce a little bit harder. Maybe you're trimming some of the fat and keeping those that are more productive. So I think a lot of the GDP forecasts are based on the idea that we're going to have stronger productivity growth, but that doesn't necessarily translate, at least for the next year, as far as stronger labor market growth.
And Jen, you mentioned the benchmark revisions, and I just want to remind viewers what they are, when they're coming, and what people need to know about that.
Right. So those are going to be coming on February 6th, which is the next date. The Labor Department will put out the next monthly employment report, and they do this every year, and they go back, and as we've seen every single month, we have seen revisions downward. That has been the trend. We saw it again this month. Both October and November were revised down. So we're already light on payroll growth for December at 50,000. Are we going to see that revised down again? And again, this is not just for, the past month. This is going to be for the past year. And they do this every year. This is going to give us a more clear picture of where the job market stood over the past year. Of course, as it comes to the Federal Reserve, they're looking more forward and what they need to be doing in terms of setting rates for the health of the job market and the economy.
And, we did, even though, people aren't really expecting a Fed cut this month, we got some more comments, or are expecting some more comments from Treasury Secretary Bessingen, right, about the Fed chair decision that could be coming. And, not surprisingly, he says rates need to be lower.
Yeah, exactly. Look, if the Fed cuts just one more time this year, that's not going to cut it for this administration. The president and the rest of the administration are going to continue to hammer the Fed. Of course, as you mentioned, we are expected to get a new Fed chair come May, and we are waiting on who that person is going to be. And Besson offered an update yesterday saying that there's still one more interview left in the process for BlackRock's Rick Reeder, and that he expects the president will make a decision either before or after he heads to Davos, which is slated for January 21st and 22nd. We know that whoever the president is going to put in place is going to err on the dovish side. That is a requirement in the president's mind for whoever the next Fed chair is going to be. So perhaps in the second half of the year, we could see more rate cuts, perhaps more than the one that the Fed has penciled in at this point. However, that person is going to have to contend with the other 18 members of the Federal Open Market Committee who may not favor lowering rates. So it'll be an interesting dynamic to watch.
So Brian, put all this together in terms of stock strategy based on this sort of complicated tightrope economic picture that we're seeing right now.
Yeah, the way that I'm looking at it, at least short term here, there's still a lot to like about the equity markets. If we get a favorable ruling for businesses with tariffs saying that, maybe you have to get the refunds and tariffs have to come lower, we know we'll eventually get tariffs, but it does put an upper limit as to where they can go. And perhaps that can help the bottom line, the profitability of firms. So the fundamentals, I think, are okay. Even though the labor market might not be the strongest, it's still tentative as to if it's getting traction going into the new year. Again, corporate profitability is still very strong. My big worry are the valuations. The price, is 2025 the year in which people were pricing in all the good stuff that's likely to happen in 2026? So I know it's cliched to talk about being cautiously optimistic, but I think it's better than being recklessly optimistic.
Brian, Jennifer, thank you so much. Appreciate it.
Thank you.
Coming up on Morning Brief, we're going to bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching nuclear stocks, Rio Tinto and Glencore, and Intel. Markets data editor Jared Blickery is here with me now to talk about some of these. Let's talk about nuclear first. Oklo and Vistra are in focus. These companies, plus privately held TerraPower, are making deals for electricity with Meta to power data centers. And this announcement makes Meta the biggest buyer of nuclear power among the hyperscalers. Really interesting. Now, there's a big caveat here. The Oklo and TerraPower power is not, it's like 2030, 2032.
Oh, this is a long way out, long runway.
Right, so that stuff not happening right now. Vistra does have existing assets, and it's kind of, these funds are to kind of build those out, it sounds like.
Yes, upgrading certain facilities, and let me just kind of break down what some of these players do. Oklo builds small nuclear reactors, and as you said, Vistra runs U.S. power plants. They have 3 nuclear stations, and they're looking as part of this deal to ramp up some of the production capability at 3 different plants: Perry, Ohio, Davis-Besse, Ohio, and Beaver Valley, Pennsylvania. And these are very long-term agreements. We're talking about 20 years here. This would boost the total megawatts from 2,176 megawatts, that's a big number, to 433. So we're talking about an addition of about 1/4 of their capacity. The timing, this would start later this year, but the full ramp isn't going to be until 2034. And there's also some regulatory risk here. They have to pass review from the Nuclear Regulatory Commission. There could be upgrade delays, and there's also no pricing disclosed. So there are some factors here.
And I just want to mention as well, something that Meta says in its release. We pay the full cost for energy used by our data centers so consumers don't bear these expenses. And they say that very deliberately because this is a hot button issue right now. Data centers are being blamed for partially driving up electricity costs. So obviously Meta is quite cognizant of that in making that distinction.
Yes, it's an election year. This is going to be an issue. Even if Meta is 100% and it doesn't affect anybody, it's still going to be an issue.
Yeah, for sure.
I just want to chart some things real quickly. Let's go to the Wi-Fi Interactive. I thought I'd just kind of chart. Here's Meta over 1 year, and in the pre-market, it's up an additional 0.25%, so not a huge amount there, but it's basically been trading sideways for a while. Here's Oklo. Now, this stock is still up 273% over the trailing year, but you can see it is well off of its highs. It's just a very volatile stock. Utilities became an AI trade, and this is AI volatility baked in. And in the pre-market, it is up almost 18%. And then Vistra paints a different picture. It's slightly red, just barely, about 6% over the trailing year, but it is also up about 17% in the pre-market. And we'll have to see where things shake out at the end of the day, but it sounds bullish for utilities overall. And this is just that other AI trade.
Yeah, and the distinction, of course, between these two is that Vistra actually produces power now, and Oklo is still highly experimental, is working on these small modular reactors that are supposed to be the next wave of nuclear technology. We'll see how that all plays out. Let's talk about our next movers, Glencore and Rio Tinto, the two mining giants confirming they are back at the negotiating table for takeover talks. Glencore shares jumping on that news, and the companies did have talks before, back in 2024. Those ended up falling apart, but if they do end up combining, that would create the world's largest mining company. So, big deal.
Yeah, anytime you see gold surging, especially over the last year, it's up something like 60%, you see these deals come into the fore because suddenly these companies have a huge amount of cash and they all want to buy each other, and there's just been this tendency to merge over the years. So not a surprise that we would get some deal coming out of this, but let me get into the specifics. So this would cover some or all of the businesses. There's no certainty just yet. And Julie, you were just telling me before that the coal business might be excluded from this. So.
No, it might be included in this.
Oh,
Bloomberg is reporting Rio Tinto had gotten rid of all of its coal assets back in 2018, and so Glencore still has coal assets. Bloomberg is reporting that to get this deal done, Rio might be willing to keep those coal assets. But
well, thank you for the distinction.
Goes on, yeah.
And so this would be an all-share deal, no cash, in other words. And why this matters, so this is really just another play to kind of create one of those mining superpowers. But if you take a look at some of the long-term charts of a lot of these players, they're very cyclical because commodities are cyclical. Gold will kind of go up. We'll have lots of peaks and troughs over the years. Here's a Wi-Fi Interactive. And let's just take a look at Rio Tinto. This is over the last year. I'll put a max chart on there, and you can see it finally broke out over the last few years to kind of a new trading range, and now it's trying to break out into a new one. Now, it's down slightly on the news today. That's because this is going to cost money. That's what mergers are about. But it's, they're going to fund it with stock, it looks like. Here's Glencore, and this is kind of what I'm talking about. Very sideways trading action. And this is typical of what you see the miners over the very long term. And I'll just show you the VanEck Vectors Gold Miners ETF. This was sideways trading until very recently, and this is just a huge breakout.
Yeah, that's very interesting.
But I would expect, after the hubbub kind of dies down from this current gold rally, and that it's cyclical. That's what tends to happen. You will have a new trading range, and so that's what investors are focused on here.
All right, we got to do a quick last one. That's Intel. Those shares are getting a boost after President Trump posted on Truth Social about a meeting that he had with CEO Lip Bhutan. He called the meeting great. He said the U.S. is a proud shareholder of the struggling chip maker. The government, remember, took a 10% stake back in August. Intel's had a big week. It introduced some stuff at CES, then Mobileye, in which it has a more than 20% stake, made an acquisition, and so Intel's had a good week.
Yeah, and if we go back to the Wi-Fi Interactive, we don't have a lot of details here, but I do want to show some of the charts. We're up another 2% on Intel in the pre-market. Over the trailing week here, which is every day this week, it's up about 11%. And I will show you the one-year chart too. So this stock really came alive after being kind of stuck in this trading range. Didn't even really lift off after the post-Liberation Day rally with the rest of the chip sectors, but it did come alive in September, and you can see it has doubled in price over the trailing year. I will show you a 5-year chart, and you can see it's still underwater there, and might as well show you the max chart as well. That's just a whole lot of sideways trading, and look at that range. That top is a dot-com bubble, so a little bit of work to do.
That's
in terms of reclaiming those highs.
Yes, indeed. Jared, thank you so much.
Thank you.
Appreciate it. Let's turn to big bank earnings. Big bank earnings just around the corner. The largest U.S. banks are set to report with results from JP Morgan, Goldman Sachs, Bank of America, and more out with numbers in the coming days. Here to break down the three key themes to watch is Yahoo Finance's David Hollerith here with me on set. Dave, it's good to see you. You're going to be busy here looking at what's going on here. So instead of taking them sort of one by one, let's talk about some of the big things that we should be looking for from them. And let's start with capital markets. What should we be watching?
Yeah, so I guess to summarize it all right now, there are pretty good expectations for the biggest banks going into earnings. And if we look at capital markets, that's kind of the biggest variable. So what CEOs said at the end of December at conferences was that they were expecting kind of a robust pipeline in deal making, also in IPOs. There are a number of names of big companies that have already filed to go public, and then there's even more rumors about even bigger companies like SpaceX potentially doing that. And then on the trading front, that's a little bit more difficult to predict. But last year was a historically high level of volatility, and as a result, these banks are going to show records actually across the big six in terms of their total trading haul for the year. So how sustainable that is, it's hard to kind of put a number around it, but we'll look for management commentary. And then finally, growth plans. We're talking about buybacks, dividends, and generally the regulatory tone, because regulation or deregulation has been such a big part of the bank's stories at this point. And that's something else I'll point out too, is that at this point, expectations are looking very good for the banks going into 2026. And not everyone's feeling completely great about that.
Let's talk about rates for a moment too. And this is something we talked about before, because we expect rates to start coming down more. We don't know when and by how much ultimately, but what are the then prospects for the banks on that front, and how does that feed into the lending businesses too?
Right, so it doesn't really matter as much if rates are going up or going down. I know that sounds weird, but as much as is the pace. And so the banks are looking at their expectations, and they kind of market off of that. So if rates go down at a slow enough pace, larger banks can more easily accommodate that with, say, capital markets revenue that benefits from lower rates. But if they go down more quickly or stay in the same place, or is anything is caught off guard, that can also play a factor. Also to that point though, a lot of the banks, I would say JP Morgan is kind of outside of this, but a lot of the bigger banks and the regionals have this situation where they have these massive securities portfolios that are still repricing from very low yielding securities they had in 2020 and such. So they kind of have a little bit of what you call a programmatic tailwind to their lending margins, if you will.
It sounds like from what you're saying, the outlook is pretty good on most of these fronts. Is there a risk or is there any sign of caution? What would it be that we should be listening for in these calls?
I think that's kind of going into this, the strangest thing is that it's sort of could it get any better for the biggest banks? And so the big question is that what could go wrong at this point? And I think everyone's just looking for a little bit more commentary from management to see that the trends that everyone was so hyped about through 2025 continues. And I think that there's a little bit of a thinking now too that almost everything kind of has to go right for them to sort of meet the valuations they got to at the end of last year. And obviously, bank to bank, that varies, but kind of across the bigger banks, that's kind of been the thinking amongst the analyst community.
Dave, thanks so much. Looking forward to all these numbers. Appreciate it. All right, that does it for Morning Brief. You've got Opening Bid with Brian Sazzi coming up next.